Okay, so moving forward now, let's look at Stock Market Basics Part 3. In Part 3, you'll get an introduction to the major stock market indexes. You'll also learn how these indexes work and see how using the indexes can help you identify market trends and economic cycles. The three major market indexes are the Dow Jones Industrial Average, the Standard & Poor's 500 Index, and the NASDAQ Index. So what is a stock market index? Well, it's a group of widely traded stocks used to measure overall market stability. Stocks that are considered popular amongst investors, and also stocks that have met certain criteria to belong to their particular group. Let's take a look at the Dow Jones Industrial Average. The Dow is made up of 30 different components or stocks. The Dow Jones reports daily on the total price of a group of widely held stocks. Each trading day, Monday through Friday, excluding holidays, the Dow measures the stock price of each, adds them together, then accounts for stock splits and dividends, and reports the average number of the sum total. This final daily number is thought to be the leading indicator of market stability and/or volatility. Above are some of the companies included in the Dow Jones Industrial Average. Do you recognize any of these brands? Did you know? Sometimes when a company is carrying a lot of cash on the books, they will offer what's called a stock dividend. Dividends are payments made by a corporation to its shareholder members. When a corporation earns a profit or surplus, that money can be put to two uses. It can either be reinvested in the business, called retained earnings, or it can be distributed to shareholders. Issuing stock dividends is a way to reward shareholders for investing in the company. Understanding market indexes continued. Standard & Poor's is also commonly referred to as the S&P 500. It's made up of 500 stocks. Similar to the Dow Jones, it's an average of stock prices used as a measuring tool to determine overall market stability on a broad scale. Now let's take a look at the NASDAQ. Again, similar to the Dow and S&P 500, the NASDAQ is also an index. However, like the New York Stock Exchange, it's made up of over 3,000 stocks that trade, buy, and sell on the NASDAQ exchange. And it's also used as a measuring average to determine the overall stock market condition on an even broader averaged scale. Now that you understand a little bit about the market indexes, let's look at a chart of the Dow Jones Industrial Average on a scale of well over 100 years. Looking to the far left of the chart, you'll notice the numbers 10, 100, 1,000, and 10,000. This is the point scale that's used to measure the Dow Jones Industrial Average. Looking across the bottom, you'll notice the years 1900, 1920, 1940, 1960, 1980 all the way up to 2000 and to the current date. Keep in mind as you look at this chart, it's not only a picture of how well the Dow Jones Industrial Average has performed over more than the last 100 years. This is also a snapshot of what our country's economy has been over the same time period. Looking at this chart, we can see some of the country's major historical events that have affected our economy. For example, you'll see an upswing in 1920 during our Roaring Twenties period. That was a big boom cycle for this country. And then it was followed by a bust cycle where we went down into depression. That was the Great Depression. So again, moving forward into our more modern economy, you can see an up cycle more recently, followed by another down cycle. These are referred to as boom and bust cycles in the economy. So generally, after a big boom cycle, you'll get a downward or bust cycle. It's just the ebb and flow of the market. Look at this chart and think about other historical events that have taken place over the last 100 years. Do you see where things have happened that may have had an effect on our economy? For example, the invention of television. Look at what a big upcycle our economy went through once we invented television. Well, what happened? We were able to communicate Sponsors were able to have commercials, advertise products, people bought those products, and it helped to drive our economy higher. What else happened later on? Well, the invention of computers and the internet caused another huge upcycle in our economy. Look at that. That was just back between 1980 and the year 2000. For our examples here, we chose the Dow Jones Industrial Average Index to look at because of its over 100-year history. What does the future hold for our economy? No one knows for sure. And unfortunately, we don't have a crystal ball to predict future results. However, by reviewing this chart, it would be very difficult to make an argument that the United States would not continue to experience economic growth and prosperity in the future. This is the end of Part 3 for Stock Market Basics.